Yeah, I think there are a couple takeaways from this. Number one, if you look at the Fed funds futures, actually the odds of a hike came down. For November, it dropped from 13.3% to 9.7% in the last day. And for December, the odds of any hike, whether one or two, dropped from 35.5% down to 32%. So despite coming in a little bit hotter than expected, expectations were still lower. And that was in part, if you look under the hood, the kind of exceeding expectations was attributable to lodging or shelter away from home. And actually, if you drill down below that, the shelter away from home was hotels were running at an aberrational plus 4.21%. Annualized, that's 51%. So that's probably an error that will be revised down and was abnormal. Furthermore, if you look at owner's equivalent rent, which is a huge component, compared to the Zillow is the observed rent index. That's running 4% below the rent that we're seeing in the CPI. In other words, what you're seeing in the CPI is old lagged data, and when that owner's equivalent rent catches up to the current observed rents that we're seeing with Zillow, which are much lower, I think people have comfort that inflation has come down sufficiently for the Fed to be on pause.
Okay, Thomas. So what was the market response like in the U.S. after the release of the inflation data in September?
Yeah, I think the initial response was a little bit negative, and then we had a bond auction in the afternoon that didn't go exceptionally well, and that's what caused the market to sell off midday and then kind of rebound towards the end of the day. I do think initially the market took it in stride. The bond auction kind of spooked people a little bit, and then things came to their senses. And as we're seeing today, in New York, the futures are up. Bonds are getting bid a little bit, and things seem back to normal. So I think the focus now will be towards earnings, and we start with bank earnings this morning.
All right. And even though it seems like the latest inflation level in 3.7% will not let the Fed declare victory versus the high inflation rate. And it seems the inflation level is also settling out at 3% above the Fed target at 2%. Do you think 2% is still a realistic level? Some of the market analysis and some of the market consensus, 2 won't be reached up until 2026.
I think that is a target, and the Fed is going to continue to talk about 2%. I think in the short term, it's a fantasy. But the reason they continue to talk about it is because it pins consumer expectations. If the consumer believes inflation is coming down, their actions in the current will be more relaxed. Whereas if they think inflation is going to be run away, then they start buying goods and you get a kind of wage price spiral. So as long as they keep that objective public, I think people will be relaxed. And even if we run inflation 3-4% for some time, that's perfectly okay.
So now let's talk about the Fed actions next. What would be your expectation for the Fed stances regarding this level, especially this October or probably in next November, Thomas?
Yeah, I think as we look at the Fed fund future, they're basically saying they've come out this week pretty aggressively and said the increase in yields has done a lot of their work for them. If you look at the 10-year note and you look at the long bonds. So they've basically been setting the stage that they can remain on pause for the time being. We expect that they will neither raise in November nor raise in December. So they're basically done, but they have their hand on the wheel. And if they need to, they'll do a couple more hikes. Right now, it's looking like they won't have to. They'll continue to threaten to hike in order to keep expectations low, which is the key to the name of the game. But I think at this point, they're not going to have to act as much as everyone thinks.
And right, so on that, ultimately, what will be the terminal rate for the Fed fund rate? 5.5 until 5.75%? Is it a considerable level?
Yeah, we may already be at the terminal rate, and if that's the case, then I think businesses are going to be able to better plan. The other thing that we have to keep an eye on is, and I think they're starting to get worried about now because we have debt to GDP of 120%. If the long end of the curve, if those yields continue to blow out, now they seem to have peaked around, last week or so, and they've come in, but yesterday they spiked back up. If they get close to that 5% range again, which I don't think they will, but if they do, we could enter a regime where yield curve control would start to be more in the conversation, where the Fed could actually start to go in, like you saw in Japan and like you saw in the United States from 1942 to 1947, and actually buy a little bit on the long end of the curve to keep them capped at a particular level. What we need is some stability in rates so businesses can plan, and I think that's coming to a theater near you.
Now, are you all actually talking about the inverted yield curve? And because you mentioned as well about the debt ceiling of the United States government currently facing, what's your take on that, about the debt ceiling? Because some of the news has been circulating about the government in the U.S. has been very, very prone to risk about this debt ceiling issue.
Yeah, I think that there's an awareness that debt to GDP at 120% is not ideal. We've been here before, post-World War II, so we had to borrow a lot of money for COVID. We had to borrow a lot of money for World War II. And if we look at history, the only way out of it is we do actually have to inflate our way out of it. We have to run inflation slightly above trend, in this range, 3, 4, 5%, but not more, 3, 4%. And within 3 to 5 years, we were able to bring down debt to GDP from 1947 to 1956, down from 120 down to 63. I think we can do a similar thing right now if we manage it responsibly.
So does this mean the era higher for longer is here to stay, Thomas?
I think above trend inflation for longer. As far as rates go, I think this level will be the peak, and maybe they go a little bit lower mid next year, but I think the economic growth is strong enough that they'll be able to keep them up at these levels or in the neighborhood. All
right. Now about the producer price index, the government data earlier reported that the producer price index rose around 0.5% in September, lifted by higher petrol and food prices, although underlying inflationary pressures at the factory level continue to ease. Can you elaborate more the effect on this?
Yeah, I think high petrol, you have a combination of factors. Number one is seasonal factors, but number two, you saw the Saudis holding back some supply, which is a function of the current administration's energy policy, putting us in a more vulnerable position to foreign producers versus our domestic production, which was paramount in previous administrations. So I think it's just a function of short-term policy and short-term thinking that was reflected. I do think moving forward, the U.S. supply seems to be coming back pretty aggressively to pre-pandemic levels and record levels, and that's why you're seeing in the case of Israel that over this weekend we used to get $20 geopolitical oil premiums when you had a regional conflict in the Middle East, and this week you're seeing it be a lot more subdued.
And as we're speaking, we just saw the video of President Joe Biden celebrating the record of 336,000 new jobs in September in the United States, which is the most in 8 months and almost double the number expected by economists in the Reuters survey. How do you interpret this news for the U.S. market as a whole? Because at the same time, it indicates that the U.S. economy is still growing in a very robust level.
Yeah, it's good news from the one standpoint that it does show a stronger economy and set up for a Goldilocks soft landing. But actually, if you look under the surface, there were a lot of part-time jobs gained, a lot of full-time jobs lost, and a lot of government jobs added. So it's kind of a mixed bag, maybe not as great as advertised.
And now that the inflation rate is still at a level of 3%, and the Fed has been making a lot of aggressive stances for this past year, do you think that the macroeconomic side will just need to absorb first what the Fed has did, Thomas?
Yeah, I think that's exactly it. I think the Fed has come to the realization that they got it under control. It may run a little bit hotter than their target of 2% for some time, and that's a good thing considering our debt to GDP level. They'll have to keep an eye on the long end of the curve, make sure those yields don't really, on the 10-year note, get too far above 5%, which I think we may have put in the peak earlier this week. And if they could do all those things, then they can kind of sit back, not do any further tightening, maybe not have to do any easing until later next year, which would be a positive thing. Let the economy kind of absorb all the tightening is the strategy moving forward.
Yeah, sure. And let's talk about another external events also correlating with the inflation level. How do you think the geopolitical events and international economic factors impact the Fed's approach to inflation management, such as wars that are happening in Russia and Ukraine and the escalations of impact of Israel versus Hamas currently?
Yeah, I think you kind of saw it with the 10-year note this week with the Israeli conflict, with the Hamas attack on the Israeli people, that the 10-year note got bid. Yields came in a little bit on that. Part of that was a safe haven bid. Part of it might be a realization that in that environment and the geopolitical risk, the Fed can't continue to move so aggressively, and the Fed may have to sit back and wait and see how these events play out, because there are new variables that were not in place when they were doing the aggressive tightening, and may afford them the ability with the bid into treasuries to kind of sit back, let the lagged effect of their tightenings kick in, and keep an eye on these geopolitical events. The good news is we haven't seen the dramatic spike in oil that historically we would have seen during the events. And if you look back on a company by company basis, even this regional conflict probably will not affect aggregate earnings power. So we can have that Goldilocks environment moving forward.